Chapter 12, Introduction Managerial Accounting, Relevant Costs for Decision Making. Today we're going to start making decisions. Not that you haven't made so many decisions by this time of the day, but now we're going to look for everything that you're making, all the decisions that you're making, you're taking during your day, during the week, during the month, during your entire life. And we're going to put some meaning in terms of terms and some explanation to the managerial account. Decision making, as you remember, is one of part of the main activity of managers. The other main activity of managers was to set the goal, to prepare the plan, to directly motivate, to control, and make decisions. So now we're making decisions. What do we need to do in order to make a decision? First, we have to find alternatives. Then we have to know how the costs behave. Costs behave as a variable and fixed cost. Variable cost per unit stays the same. Fixed cost in total stays the same. Variable cost in total fluctuate based on the usage. Fixed cost per unit fluctuate going down based on the usage. Now, knowing that, when we're making decisions, obviously we're going to identify the alternatives. At least we need two alternatives, otherwise there'll be no decision. And during those alternatives, we have to decide which, we're going to gather the information in terms of the cost, and then we're going to say which cost is relevant, which cost is not relevant. The relevant cost is the one who is different between one alternative and another alternative. Then we're going to see what's the other category of the cost that we have to consider in order to make our decision. That will be avoidable costs, or that will be the cost that can be eliminated as part or entirely if you choose one alternative versus another alternative. Avoidable costs are always relevant. Unavoidable cost is never relevant. There are two categories of costs which are never relevant. Those are the sunk cost and future cost that don't change between the alternatives. Sunk cost example will be something that's already happened in the past. For example, let's say you want to go to vacation in Hawaii. You already bought a laptop, which your laptop you're choosing to choose the best option way to go on vacation. Should I go in Miami? Should I go in Hawaii? You're using the laptop. Do I have to consider cost of the laptop when I'm making my decision? Since I'm using the laptop to give me the better information, obviously not. The cost of the laptop is irrelevant. Future costs that not differ between one alternative and another alternative is in both cases, I have to take a Uber to go to airport. Do I have to consider the cost of the Uber when I'm choosing to go to Miami or Hawaii? No. Why? Because in both cases, I have to go to the airport and I have to pay for that cost. So that cost is not different between going to Miami, going to Hawaii. So that cost will be not relevant, not going to be considered in order to make a decision where to go. The steps in this approach, first step is to, obviously, once we gather the information, we're going to eliminate cost and the benefits, which not change between one alternative and the other alternative, and all the remaining costs and benefits, which are different between one alternative and another alternative, we're going to consider. They can be differential, can be avoidable, can be anything else. We're going to see how it's going to go. What we have to remember is cost in one alternative can be relevant, and another point of view can be irrelevant. Not all the costs are relevant for the same decision. And the relevance of the cost is changing, depends on the situation. In one context it's relevant, in the other context it's not relevant. Example here will be this person, a student who wants to go to visit her friends on the relatively long trip, 230 kilometers, back and forth. Want to go 230 to see her friends in her apartment and 230 to come back. Currently, she's on the campus. She's living in the campus in the school, and she prepares some information for us. She decided to go, and she has two alternatives. One to go with the car. The other one is to take a train. And she asked, okay, which alternative should I take? So now she prepares some information, and the first of all the costs that she considered for her decision is the annual straight line depreciation of the car. Now, as we remember, the cost of the car is same cost, so it's irrelevant. So how much will be the effect on the annual depreciation if we go with the car or we go with the train? That's not going to change. Why? Because the car depreciates regardless. Even if you leave it in the parking lot and take the train, the depreciation is still going to go. So for that reason, annual depreciation is not going to be considered. Cost of the gasoline obviously will be considered. Whatever she has to pay per mile, we have to consider that cost. Annual cost for the auto insurance and the license. The tricky part for this is usually we're paying the auto insurance upfront, preferably for the entire year because it gives you some saving. So once we pay, we can use the car for the entire year. Now the question is, if she decides to go with the train, do you think there'll be an agent from the insurance company that she bought the insurance sitting on the station and ask her, excuse me, where are you going? I'm going to visit my friend. For how long are you going to be there? For 2 days. You know what? I'm going to give you a refund for the car because obviously you're not going with your car. I'm going to give you a refund for 2 days. That's never going to happen. Let's be honest. So for that reason, the annual cost of the insurance that she already paid, it's not going to be considered a relevant cost for this decision, how to go to visit her friend. Parking, maintenance and repair. Maintenance repair, every time when the car is driven, it has to be maintained. And if something happens, it has to be repaired. So that will be a relevant cost, which will be considered. Parking fee at the school, she already paid for the monthly parking fee for the school or annual fee for the school for $360. Now, regardless if she stop on the parking or not stop on the parking, she already paid for the parking. So in that case, that will be irrelevant cost. So for example, if you working in downtown and you pay for the monthly fee, the parking, and one of the days you get sick or you decide to take a day off, do you think you're going to get a refund from the parking company that you're not using the parking for that particular day? I don't think so. So for that reason, the parking fee of the school is going to be irrelevant cost, so we're not going to consider that cost. The next information that you prepare for us is the reduction in the resale value of the car per kilometers of driving the car. So every kilometer that you drive in the car is going to reduce its value by that much. So that's definitely a cost to consider since kilometers are involved. The round trip of the train definitely will be considered because that's the cost for the second alternative. Benefits on the relaxing on the train. Yes, so when you take the train, yeah, can we relax on the train? Yes, we can. Can we sitting on the phone all the time? Yes, probably that's exactly what we're going to do. So for that reason, there'll be definitely benefits, but since we cannot measure it with the dollar amount, we're going to leave it inside. Cost of putting the dog in kennel while gone. So in both cases, regardless how she's going to travel with the train or with the car. She has to put that dog in that dog hotel, and it's going to cost her $40. So that cost is unavoidable, and it doesn't differ between the both decisions or alternatives. And so for that reason, we're not going to consider that cost. Benefit of having the car and hassle to parking the car when she go to her friend's place. Definitely there'll be benefits. Most likely there'll be a problem with parking the car, but since those cannot be measured, it's not going to be considered. And the last thing left is the payday per day cost for parking the car in the place where her friend is. Yeah, we definitely have to consider that cost, because if she goes with the car, she has to pay for that. So in summary, cost of the car, same cost, not relevant. Annual cost for the insurance, again, same cost, not relevant. Cost of the gasoline is clearly relevant. So if she takes the train, cost will be incurred, and that will be very, depends on the decision. Cost of the maintenance repair is relevant. Monthly school parking lot fee, that's not relevant, since it's a cost that doesn't change between the both alternatives, and it's already been paid. At this point, the only relevant cost is the cost of the gasoline and repair and maintenance. For the declining resale value, yes, that's relevant. Round trip of the train, clearly relevant, since that's the cost of the alternative decision. The alternative. Relaxing on the train, relevant, but hard to measure. Final cost for the dog, irrelevant, since it doesn't change between one alternative and another alternative. Cost of the parking, definitely relevant, because if she takes the car, she has to consider that cost. And the benefits of having the car and hassle to park, again, it's going to be hard to measure. So at this point, when we calculate all the costs based on the 460 kilometers that she has to drive for the round trip, going with the car is going to cost us $114.86. Taking the train, $104. So based clearly on the cost and on the cost only, better decision will be to take the train. Now, if the cost between, or the difference between the both alternative end up within $10, then you definitely have to do the qualitative analysis as well. What if she can drive the car, and what will be her preferences? Because personally, if the difference is only $10, I would still prefer to go with the car. Why? Because it gives me freedom to make last-minute decisions. When I'm with the train, I'm stuck with the train. So one way to make a decision is identifying the relevant cost, irrelevant cost, sunk cost, eliminate irrelevant cost, consider only relevant costs, do the cost analysis, do qualitative analysis, go for it. The alternative will be to go with the differential cost approach. And differential cost approach, in some circumstances, may not have ability to prepare the entire income statement for the company. So what we can do is we can just see if this happens, what's going to happen, and what will be the cost saving. For example, current situation, the company, currently they're making $18,000. What they're trying to do is, if they rent a new machine for $3,000, they can save $15,000 on the labor. Should they do that or should they not? What will be the effect on the net income? $15,000 savings minus $3,000 cost of the rental. That's going to give you $12,000 savings. Definitely, it's beneficial. Definitely, it's going to increase the income. So again, one option is to prepare the entire income statement. The other option is to extract only the differences between cost savings and additional costs that we have to pay for the implementing the other decision. You have to understand the increase in the income or costs or savings. It's not always going to come from increased revenue. or increase of sales. It's going to come from reduction of the cost as well. That's another thing to consider. Utilization of the fixed cost is also another option, another alternative for you to increase the profitability or operating income. Now, for the total differential approaches, we have to be careful. We have to only rely on the enough information to be available to prepare detailed income statement. So for that reason, since we won't be able to have that information available, we better go with the, if this happens, what will be the saving, or if this won't happen, what will be the direct increase in sales, and how much will be the cost. And playing with those irrelevant costs, with the relevant and irrelevant costs, it might be confusing, and it might be a reason for preparing reports which are not accurate, and then making your own decisions based on inaccurate reports. Now let's start by knowing which kind of methods we're going to use. Either we're going to split the cost relevant and irrelevant, either we're going to go with the differential approach or incremental approach if you want. Let's start making decisions. The first decision today will be, should I add or drop a segment? Or should I add or drop a product? Should I add or drop a client? All those different variations of the same idea, should I add and drop segment? That's one of the most important decisions that you as a manager have to make one day. To drop a business segment, such a product or store or customer. Now let's see how the relevant cost should be used in this type of decision. Due to the declining popularity of digital watches, this company, Digital Watch Line, was not reporting profit for several years. The company, considering, discontinued this product line completely. Decision rule is, if we decide to drop the line, if net income increase or contribution margin increase, then go for it. If the net income decline, no go. So what will be the, what's going to trigger net income increase? That will be contribution margin. Since most likely this only going to happen when the contribution margin is positive, so that's going to happen. That's when the fixed cost is already covered. So what we have to do is we have to consider that contribution margin that we losing. If the contribution margin lost is more than the cost saving, no go. If the cost saving, mostly from the fixed cost, is more than the contribution margin loss, if you save more than you're losing as coming in, yes, go for it. Let's see the information here. We have this information for this company. What I can do is I can copy this entire information and move to Excel spreadsheet. And we can play with the Excel spreadsheet. You see, it's gonna let me do that. If you let me do that, I'm gonna transfer it to Excel spreadsheet. See how this is gonna look like. Yeah, I have a good outcome on the Excel spreadsheet. So let me share my Excel spreadsheet with you. So we have the information for this company. I'm going to extend the entire thing, and I'm going to do some changes just to be more useful. The information, increase the numbers so you can see them, and we're good to go. That's the information that we have for this company. As we can see, the company definitely generate losses. This digital watch generating loss at this point. And it's going to be like this. So the sales are $500,000. Then we have the variable cost, which is variable cost at $200. Of all those three costs, $200,000. Now contribution margin is 500 minus the 200, that's 300,000. And then we're going to have sum of all those costs, which is going to be 400,000, and we're losing 300 minus 400, we're losing $100,000. Now the question is, should I drop this division or should I not? In order to make that decision, we need a little bit more information. And on the slides, on the next slides, there'll be a little bit more information coming, which is going to help us to make a decision. I'm going to bring that information here, not like that. Hold on. Around choice now, let's see, we have investigation reviews that the total fixed general and factory overhead, this one, see this cost, and the general administrative expenses, those two, will not be affected if the digital line is dropped. What means that the fixed general factory overhead and general administrative expenses assigned to this product will be reallocated to the other products. So what's going to happen? If I decide to eliminate this division, what's going to disappear and what's going to stay? So let's put this one here. Let's see what will be the effect now if I decide to move it or to eliminate this division. What's going to happen? And as we can see from the additional information, the yellow is going to stay, the green is going to disappear. So if I eliminate this, all the green stuff disappears. The yellow is going to stay with the company. Why? Because we cannot eliminate that cost. Okay, so far, if everything that stays up to this point, we're losing $10,000, we're not losing $100,000. Okay, that's good. We have a starting point in our analysis. If we eliminate, so what's going to happen if we eliminate general factor overhead and general administrative expenses? So they simply should not be allocated to this division since looks like they're common cost. Let's see what else is available for us. The other thing that's available for us is the information about the equipment that we're using to produce those digital watches. The equipment which is used to manufacture the watches, which we currently allocating the depreciation expense, that particular equipment has no resale value. So if I stop this division, I cannot sell the equipment. And I cannot use it for anything else. So if I stop it, this thing is going to disappear. So based on what we see here is currently from the information provided for our accounting department, we looks like we're losing $100. But when we add the information that we have about the fixed general factor overhead, the general administrative expenses, which cannot be eliminated, and when we see that the equipment is no resale value, has no alternatives, and eliminate that equipment, then we're going to see that this division actually producing $40,000 operating income. It's not loss anymore. So what's going to happen if I drop this division? Should I drop it or should I keep it? That will be the question. If I drop it, so now let's go to somewhere and let's think a different way, the differential approach. Which differential approach will be if I drop a division, what I can save, and if I keep the division, what's going to happen? So if I keep it, everything stays. If I drop it, if I drop this division, well, this will disappear, minus 500,000. This cost will disappear. Let me put this one here. This one is gone. Variable cost gone. Variable shipping cost gone. Commissions gone. So contribution margin will be 0. So we're losing compared to this situation, this scenario, we're losing difference. If that's what we're going to do, if we drop it, the difference will be here. This one minus the contribution. So we're losing the contribution margin. Contribution margin is totally gone. There's no way we to recover it because once we stop doing what we're doing, the contribution margin is gone. Fine, that's a good starting point. Let's see what else we can get. If we drop it, general overhead not going to be affected. It's going to stay. Salary of the line manager, we don't need it. That's gone. Factory depreciation, that's going to stay because there's nothing. There's no resale value. We cannot use it for anything. That's going to stay with us. Advertising direct cost, that's gone. Rent factory space, we're not renting anymore the space. That one gone. The general administrative expense is going to stay with us. So $140,000 is going to stay with the company. So what we saved? We saved in that case will be this one minus on the savings going to be this. We're not saving on the general factory overhead. That stay with us. We're saving 90,000 with the salary of the line manager. We're not saving on the depreciation. We're saving 100,000 on the advertising expenses, which we don't have to pay anymore. And we're saving on the factory rent space. On the general administrative expenses, there's no savings. So the question is where we are. Well, we are saving, we are losing 300,000, but we're saving 90 minus 100 is another saving, minus 70. Oops, that's too much. Minus, minus, minus. That will be minus, that will be in that case plus, so that's saving. That is saving, and that is saving. So if we do what we're doing, if we drop it, we're going to lose $40,000. Currently, we're losing 100. If we drop it, we're going to lose additional $40,000. Shall we drop this division or shall we not? That will be the biggest question. Let's go to the slides and see the explanation of the slides. Again, this is the scenario. From the additional information, we're seeing that the general factory overhead and the general administrative expenses are irrelevant costs. Those are common costs for the company. The factory equipment, which producing those digital watches, has no resale value, so there's no use for that cost. Shall we retain the division or shall we drop it? Now, if we drop the division, we're losing the contribution margin. We're going to save on the salary line manager, advertising director, rent expenses. So total savings is going to be 260. So in fact, if we drop this division, we're going to lose $40,000. Which $40,000 now they're going to add. Now, how can we see the whole situation? When we prepare the entire income statement. So the difference will be if we drop the watches, all those things go. So the contribution margin going $300,000. On the expenses, factory overhead, we cannot lose it. It's going to stay with us. The equipment depreciation, it's not going to be affected because since we cannot use the equipment for anything else, cannot sell it, nothing we can do with that. Advertising there is going to disappear. So if we move away from this decision, our net operating loss is going to be 140,000. Right now it's 100,000. If we drop it, it's going to be 140,000. The question is, do we want to eliminate which scenario will be better, by losing 100 or by losing 140,000? Why are we losing it? Why should we keep this segment when we're showing the loss of $100,000? Because there's a cost we shouldn't be allocated. Which are those common costs for the company? If the common costs for the company are allocated to the segment, that shows results which may lead the managers to the wrong decision. By the time that manager figure out that he made the wrong decision, it might be too late. So be careful with that. One day when you become a manager, be careful with the reports that are given to you and pay attention for the relevant, irrelevant, and traceable and common cost. So the next decision that we have to do is shall we make it at home, shall we cook at home, or shall we go to McDonald's? What exactly we should do? Now, when the company is involved in more than one activity in the entire value chain, so that means the company starting with research development, product design, manufacturing, marketing, delivery, customer service, if it has all the elements or more than one of the activity in the entire value chain, we call it that the company is vertically integrated. The problem is sometimes we might free ourselves from certain activity and buy it from outside. But we're only going to buy it if it's cheaper. So that particular decision is called make versus buy decision. Which are the benefits if we decide to go and eat outside? If we decide to eat outside, obviously we're going to have access to different type of food, variety of food. We can save time. We don't have to do the dishes. Those would definitely be the benefits if we decide to go with somebody outside. Now, what will be the advantages if we decide to cook at home? Obviously, we can control the materials, the quality of the materials. We can control the ingredients. We can achieve better control than eating outside. And since you're the one who producing the product, you have the opportunity to realize the higher profit than just going outside and buying for somebody else. So for those reasons, we have some information about this product. We have this company manufacture this product. Part 4A. Let me copy this information and again move it to Excel spreadsheet. See if it's going to give it to me or no. It somehow disappeared this time. And unfortunately, it's locked the Excel spreadsheet disappeared completely. Let me see if I can somehow unlock it. The other day I complained about Excel a lot because what's happening with Excel is every time when they're doing new updates, something dramatically goes wrong. Unfortunately, they don't care anymore about the customers, and we have to chase them, we have to make a complaint, and they usually say their responses are not very good. So, but what can you do when you're dealing with a company which has monopoly over everything, especially Excel spreadsheets, which we're using? So for that reason, let's start again with our Excel spreadsheet. I'm almost there. Just give me a second. I'm almost able to recover everything. Now, the only thing that they have to get is from the slides to extract this Excel Excel sheets, and we can move to the Excel. Now I have to save this one somewhere, otherwise I'm gonna lose it. Okay, so covered. We're covered. Now we can continue with our journey. Now I have the information. Let's see if it's gonna let me do it this time. I believe I can now. Question 2, and this is the information for this product. We have this product which has direct material, direct labor, manufacturing overhead, depreciation, general factory, and all the other different costs which are given to us on this for the purpose of this question. Now, magically, at this point, once we have the cost of our product, then there's going to be somebody coming and say, hey, can you, I'm here to save you. I can see that your cost is $30, and I want to give you the same product for different price. Now we have to decide, shall we take this offer or shall we not? So in this case, the special equipment uses the manufacturer part 1, has no resale value. Total amount of the general factory overhead, which is allocated to the basic direct labor hours, would not be affected by this decision. The $30 unit product cost is based on 20,000 parts produced each year. The outside company come and say, hey, I have an offer for you to provide those 20,000 parts that you're producing at $30. I can sell it to you for $25. The question is, shall we take the offer or not? Let's move to Excel again and do some thinking based now on the new information that we have. It doesn't let me do the thinking because the Excel is stuck somewhere. Let me try and close it and open it again. Usually that works, sometimes it doesn't. I hope this time it's going to work. Otherwise, we have to start again. Okay, I was able to move to Excel and post the information in Excel. Let's go now. The special again. On the older information that we have, the special equipment which we're using, has no resale value. So we're claiming a depreciation on that equipment. Let's highlight it in different color. This depreciation looks like irrelevant. The total amount of general factory overhead, which is now allocated on the basis of direct labor hour, this is the basis, will be unaffected by this decision. So the general factory overhead that we're allocating is irrelevant. That's a common cost somebody tried to allocate to this product. And outside supplier offers to provide 20,000 parts. So here, if we have to recalculate what we have, we should eliminate the one that is relevant, not relevant, and leave only with the relevant. So we said that depreciation is irrelevant, and we said the general factory is irrelevant. So in that case, our cost per product becomes 70. Somebody comes and say, I can sell you this product for $25. So we can buy it from outside for $25. What do you think? Shall we take the offer or not? Shall we buy something for 25, which costs us only 7? What do you think? Yes or no? Let's see what's going to happen. We're talking about the 20,000 units, correct? We're talking about 20,000 units. If we have to produce those 20,000 units ourselves, how much will be our cost? Our cost will be 9 times 20,000. It's going to be this ginormous 180. Those will be the, sorry, that's not going to be the cost. I have to lock this cell here. Now I have 180 and everything. So I'm going to generate these costs here. My total cost for the product is going to be $340,000. If I decide to buy it, those 20,000 units, now my direct material is going to be 0. My direct labor is going to be 0. Variable overhead is going to be 0. Depreciation, that's going to stay with me. My supervision cell is going to be 0. And I have to pay $25 for each unit. So I have to pay $500,000 for something that is going to cost me $340,000. So how much is the difference here? The way I see it, the difference is exactly $160,000. From where that difference come from? Well, obviously, that difference is going to come from the fact that we have $8 difference on the unit price. We have our $8 difference times 20,000 units. Oops, that's too much. That's going to be this one minus that one, 160. So $8 times 20,000 units is going to give us $160,000 difference. So what shall we do? Shall we purchase it from outside and spend $160,000 more, or shall we make it? That's where the question is going to be. Again, if we decide to make it, it's going to cost us $340,000. If we decide to buy, it's going to cost us $500,000 or $160,000 more. Why? Because we're talking about 20,000 units. on which we have $7 savings. Next thing that we have to consider, next type of cost that we have to consider is called opportunity cost. Opportunity cost is, this is not the cost that we have to pay, but more like a cost that we have to consider every time when we decide to which alternative to choose between one alternative and the other alternative. And that opportunity cost is related to the benefits which are foregone as a result of choosing one course of action versus another course of action. It's not actual dollar outlay, so we don't have to pay for the opportunity cost. And those are not recognized on the formal accounts of the organization, but it needs to be considered. So how can we express this concept? By the special order. Special order is one-time and one-time only order, which is not considered part of the company normal operating business. For example, if the company during the normal operating business sells the products of certain product, which is sold for $20, and a special order will be one-time and one-time order and offer coming from this particular supplier, which asking is, can you sell me that many parts, let's say 20,000 parts, at special price of $12 on. Now, what's going to happen with this special, obviously below our normal selling price? What we need to consider is that our business going to be affected. If our business is not affected, then we might consider that offer. The other thing that we can have to consider is we have to apply the incremental costs and benefits, and as long as the benefits are more than the cost, we may consider that special order. Again, our other customers not going to find about this special order. Our business is going to be not going to be affected, and we have enough capacity to produce the required units for the special order. So let's see the question here. This company make a single product whose normal selling price is $20. Foreign distributors offer to purchase 3,000 units. So I'm going to buy 3,000 units for $10 per unit. This is one time and one time only. It's not going to affect our business. It's not going to affect our customers. Nobody's going to know about it. Annual capacity of our company is 10,000 units. And currently we're producing and selling 5,000. So we're definitely below the capacity. We have the capacity. Also, we have capacity to produce this order. We have a 3,000 units capacity to get this order. The question, shall we accept or not? First, we have to get some information. And what will be our information? Our information is going to be taken from the current financial reports that we prepare. And we're going to see the contribution income statement, which is very helpful in this case. And we're going to see that the revenue is 100,000, 5,000 times 20, 100,000. Direct material, direct labor, manufacturing overhead, marketing costs altogether. Total variable cost per one unit, $8 per unit. Contribution margin generating is $60,000. So we are above the fixed cost. So a fixed cost, in this case, if we accept the special order, it's not going to be relevant because, again, we are above the fixed cost. So we are on both the break-even point. So the only thing that we have to worry is the variable cost. So what we have to decide is the additional contribution margin positive or negative in this case. So since the client offered us $10 per unit and our variable cost is $8 and we are above the break-even or the fixed cost is not going to be affected, we have the capacity to do it. Obviously, we're going to generate $2 for each unit. And we're talking about 3,000 units. So that means 3,000 units times $2. That's going to be easy $6,000 for us. The question is, do we want to do it or not? So again, If we decide to go, 3,000 times $10 is going to give you $30,000 increase in revenue. Cost is going to increase with $24,000 because 3,000 units that we produce, $8,000 per unit, $8 per unit, that's $24,000. But as you can see, the increase in revenue is more than the increase in the cost. So we're going to generate 6,000. The answer is that fixed costs are unavoidable and the variable marketing cost must be incurred for the special order. Let's see now example. And let's apply what we just saw on this example. So for this example, I'm going to drag the information. I'm going to copy the information, move it to the Excel spreadsheet. I hope this Excel is going to be cooperative at this point, since we're going to do the calculation ourselves. This is one part of the question. This is the second part of the question. And since I have both parts of the questions, I can switch to Excel spreadsheet, which is right here. Now, this company, let's see quickly what this company is doing and what they're selling and what they're not selling. First, they are selling sales price for 1 unit is $50 per unit. That's how much they're selling this product, $50 per unit. We know that they have a variable cost of $18. Sorry, $10 variable cost. What else they have? Variable selling cost for selling. It's another $1. Also, they have fixed cost, and the fixed cost is $18. Customer coming and asking, can you sell me 110,000 units of these lenses that we produce? 10,000 lenses. He wants 10,000 lenses. Now, for this specific order, we have to, which is not involve selling cost. So which cost is going to stay for this? If we're not involving the selling cost will disappear. So the only relevant cost will be the variable cost. On the selling cost, that will be 0. Since the client coming in order, we're not consider that. But we're going to have the special order will not involve selling cost, but this company would have to purchase imprinting machine for $50,000. So we have to purchase machine for $50,000. That will be a new cost, new machine that we need for this order and this order. Okay. So we're not going to go to the next page because the slides is right here. And we're going to move the slides here. We're going to kind of cover ourselves with all the slides in this case. So the question is, what is the rock bottom minimum price below of which Norton Optical should not go with this negotiation with the clients? In other words, below what price Norton Optical actually be losing money on the sales. Now, the last thing that left is where we are on the capacity. And here says, we have a handle capacity. That means capacity is not my goal. I can produce those lenses. So what shall we do? Shall we make it or shall we not? Let's do, and what will be the minimum price that we cannot go below? First, let's think about it. If we produce those 10,000, we need, so that will be per unit here. And let's go here in total. Per unit, we need to have variable cost $10,000, and in total, we need to spend $50,000 on this equipment, special equipment that we have to purchase. Why are we purchasing it? Because we're producing 10,000 units. That's our total production, 10,000 units. So what will be the cost per unit? Variable cost is $10 per unit. For the new machine, how much, since we have to produce 10,000, how much will be for one unit, the cost of this 50,000 for the new machine based on the 10,000 units production? We can easily calculate it. The cost is going to be 50 divided by 10,000. What will be the total variable cost in this case? Total variable cost is going to be $10 times 100,000 units, or it's going to be 100,000. So what will be our total cost to produce those 10,000 units? The total cost is going to be 150,000. How much will be the cost per unit? Cost per unit is going to be $15. So what's the minimum price per unit that we cannot go below? Or what will be the price? If the client comes and say, I'm paying you $18, are we gonna per unit? Are we gonna accept the offer? If the client comes and say, I can pay you $14.50, are we gonna accept the offer? Again, client comes and say, I offer you $14.50. Are we going to accept the offer? No. Why? Our cost is $15. I can make it at 15, but that will be the rock bottom. Below that, I cannot go. Make sense? Okay, that's with the special order. Let's go back to our slides and see. Obviously, the answer is going to lie on the calculation of variable cost. So again, you can go with the units, you can go in total. Now they're going with the total and then convert it by unit. 100,000 variable cost to produce 10,000, 50,000 for the machine, total 150,000 total cost, divided by 10,000 units, $15. The other option is, since the variable cost is given per unit, convert the machine, the cost for the machine, 50,000, divided by 10,000, convert it per unit, how much is have to spread it per unit, and that's going to be $5 per unit, total $15. Joint cost. Joint cost is interesting point. In some industry, we have number of ending products which are produced from the single raw material. Two or more products produced from the common input are called joint product. For example, I'm dairy farmer. I'm producing milk. I can sell milk, but I can sell other products which using the same common input, which will be milk. So I can produce cheese, I can produce butter, I can produce cream, I can produce half and half, I can produce yogurt, so many options. But they have a common input, which is milk. Or I can sell milk. All those products are going to be called joint products. The point of the manufacturing process, where each joint product can be recognized as a separate product, is called split off point. So at some point, once we can see, okay, this is a cheese now, this is a butter, this is a cream, this is a milk, the other one goes yogurt. then that will be the split of point. Split of point simply is going to be, we have a joint input, common product process for that joint input, and at some point we're splitting the product into oil, gasoline, and chemicals. The point that I can identify each of those is called split of point. Now the joint product, once we have the split of point, then we have to decide, what should I do with the oil? Should I sell it as it is, or should I go further, process it something else? Gasoline, can I sell it as it is? And chemicals, can I sell it as it is, or should I process it further? What's the decision rule here? Joint costs are often allocated to the end of the product based on the relative sales value. You're going to see, for those of you going to go with the intermediate accounting and managerial accounting, they're going to see how this joint cost is going to be allocated. There are different methods of allocation of joint costs. That's not important for us here. What's happened in the past, leave it in the past. That's the same cost. So for that one, although allocation is needed in some purposes, such a balance sheet inventory valuation, allocation of this kind of is very dangerous for decision making. So for that reason, all the costs up to the split of point are not considered. So the joint costs are irrelevant in the decision regarding what we're going to do going forward from the split of points. So up to the split of point, whatever cost you have, you ignore it. And then what we're going to do, we're going to see on the split of point where we are, going further, what's going to happen. It's always going to be profitable to continue to processing a joint product after the split of point, as long as the incremental revenue is more than the additional incremental cost. What that means, let me show you on the Excel spreadsheet. Let's say we have one product, which is, let's stick with the milk. I'm going to stay with the milk. I'm producing milk. And at some point I decide, okay, making milk is boring. Let's split it on different products. One product can be butter. The other product can be cream. Next product can be cheese. Next product can be yogurt. Okay, I have 4 products. That's more than enough. Let's keep it the way it is. Or let's make this yogurt a little bit down. And let's move this cheese here. And let's keep the milk the way it is. Because I can keep selling milk. And since I have those products, I can easily insert some lines here. From shape and make it more one, and that will be 2. And then we're going to have 3. Cheese here. And the last one will be yogurt. And put one here for the milk. So what will be my split of point? Obviously, now you can sense where the split of point is, where all the products are identifiable, or right here is my split of point. right at this section. At this point, I can identify each of those products as a single product. What will be the decision rule? At this point, I'm selling the milk at $6 per liter. If I convert it to butter, I can sell it. My sales price will be, let's say, $15. But my extra cost, additional cost, will be $5 for the cream. On the cream, my sales, the sales price will be $8, but my additional cost is going to be $3. For the cheese, I can sell it at, let's say, cheese, I can sell it for $20, but my additional cost is going to be 12. And for yogurt, I can sell it at, let's say, $10 per liter, but my additional cost is going to be $2. Now the question is, which one should I go for it? Which one should I not go for it? So, as we said, we only chasing the additional or the incremental cost at this point. Since I can sell it for 6 as a milk, and now I can sell it as a butter for 15, what's the additional sales that I'm generating? My additional sales will be 15 minus $6. So additional, I'm generating $9, but it's going to cost me $5 to make it. So in that case, let me switch this one, and it's going to take me $5 to make it. So where's my contribution margin? Here is going to be 9 minus 5. So I'm making $4. Should I go with this? Yes, I'm going with this. This one is green line. This one we mark it as green. Second one. In the second one, we're doing the same scenario. Same calculation. Currently, I'm selling for 8. Additional that I'm making is going to be equal to 8 minus 6. So I'm making additional $2 compared to milk. Cost to convert it will be $3 to convert it to cream. So I'm going to lose $1. So for this one, for the cream is red. So that means we're not doing the cream. Butter is fine, but the cream is not good. And the same thing we're going to do with the cheese. Let's see, the cheese should be positive, but let me see if I get it positive. The cheese, we're going to have $20 minus the 6. So the additional or incremental is going to be $14, but it's going to cost us $12 to make it. So we make $12, $2 extra. Yes, we're going to go with the cheese. For the yogurt additional that we're going to make is 10 minus 6 is going to be $4, but it's going to take us $2 to make it. So another one, go for it. So the only thing that we're not going to do is cream. Instead of making cream, we better sell it as a milk. We're going to make more. That's the general rule for the products that you decide to process further after the split of points. Again, incremental revenue has to be more than incremental cost. So it has to generate incremental contribution margin. Let's go to the slides and see our example here. This company catalogs from unfinished lumber and sawdust. Lumber and sawdust, those are immediate joint products after the logs is cut. Unfinished lumber can be sold as it is or processed further to finished lumber. Sawdust also can be sold as it is or can be processed further into the presto logs. Now, this is the information that we gonna have available. Let me grab this information and move it to Excel spreadsheet. And let's work with this information that we have. Actually, I'm gonna open a new one because once I paste this information, it's gonna be a different story. So we have the information. Valuable. Let me format a little bit the sheet so it's gonna be more usable from us. That's our information here for the lumber and for the sawdust, which is the two products from that catalogs that we have. Yeah, we have the information available. What we have to do now is to see which one is relevant, which one is not relevant. Sales going forward, what we're going to see is currently selling what we're selling and going forward what we're going to sell. So I definitely going forward, since I'm going forward, I need the sales value at going forward. And for the lumber, I'm going to make $270. For the sawdust, I'm going to take $50. Then the next question is, okay, this is if I go for it. How much will be the additional, how much is the incremental revenue? So as we can see at this point, when we're selling it at the split off point, we're generating $140 from the lumber and sawdust we're generating $40. Okay, so what we have to do, we have to do additional. How much additional we getting? From the lumber, we're getting additional $130. From the sawdust, we get additional $10. That will be additional sales. Once we have the additional sales, what we have to do, check what's the additional cost. And the cost to process further is right here. So this is our cost if we want to process it further. Once I have this cost, you can easily tell me which one's going to generate contribution margin and which one is not going to generate contribution margin. That will be question number 4. So what will be my contribution margin from the lumber? Is it going to be positive? Most likely, yes, positive. In fact, it's $80. How about on the sawdust? Opposite, it's negative. So what we're going to do? Are we going to process further the sawdust? No, we're not. We're going to sell it as it is. Lumber, yes, we're going to process it further into the new product since we're generating $80 more. Let's see the slides. Once we have this information, again, we're going to restructure the information, see what's our incremental revenue that we're generating per each of the products. $130 from the lumber, $10 from the sawdust. We're going to see what's the future cost or further cost or additional cost to produce or to make the change of from what is it to what we want to be. And for the lumber, $50 for the sawdust, $20. Lumbers generate positive profit. Yes, we're going to go for it. Sawdust generating $10 decrease. So we're not going to go to that. That with the joint cost. Next thing that left is constraints. What we're going to do when we have constraints. Probably you already sense it in our life where there's always constraints. Unfortunately, we always have to deal with the limited resources. However, there's only one limited resource in our life, even though it seems that there's so many, but there's only one limited resource in our life, and that's time. Everything else you can get it one way or another, even if it seems impossible at some point, but if you put your mind, you can find it. Time, you cannot get it. When the time comes, time comes. You may wish to have more time, there's no more. So, but in managerial accounting, we have to understand in the different process you may have some limitations, limited resources. And those limited resources going to affect our ability to satisfy demands that the company currently have. The machine or the process that holding our ability to satisfy the demand from the market, it's going to be called bottleneck. In other words, that will be our constraint. When the constraint exists, the rule is that the company should not focus on the product that generates highest contribution margin, but should focus on the product which producing the highest contribution margin within the constraint. So if you want to maximize our profit, having in mind that the fixed costs most likely already covered, we should focus on the product which gives us the highest contribution margin within the identified constraint. How this is going to work? We're going to have this example here. This company is going to have two products. Let me copy this information and move it to Excel spreadsheet. Into question 5. And let's formulate first, so we will spend a little bit less time. Fortunately, now the Excel forgot that I copied something, so I have to copy it again. There you go, that's our information now. Only thing I have to do is make it bigger and more presentable. We have product 1 and product 2. So currently, product 1 is sold for $60. Variable cost is 36, contribution margin 24. Product 2 is sold for $50, $35 variable cost, $15 contribution margin. Clearly at this point, product 1 is our winning product. Generate more contribution margin than the product 2. That's obvious for all of us. Now the question is there any constraints for us to produce those products? We have the demand, 2,000 for product 1 and 2,200 for product 2. Contribution ratio, that's irrelevant. I'm not going to spend on that. Processing time to require to produce through the machine, 1 minute product one, half a minute for product two. This is our basic information. Let's see what else the slides give us as information. Besides this here, machine one is the consider constrained resource, and that machine is used on the 100% capacity. There's excess capacity everywhere in all the other machines. Only on machine A1, we don't have excess. Machine A1 has the capacity of 2,400 minutes per week. Okay, so our capacity on machine 1, as you can see, is 2,400 minutes. That's it. That's what we have available. The question that we should ask ourselves is, once we go back to the Excel spreadsheet, is can we, with the capacity available of this machine, if this machine has the capacity of that will be the capacity of the machine A1. Capacity is only 2,400 minutes. That's it. That's how much we have. Question is, can we satisfy our demand? Let's see how many minutes we need to produce product one. Let me format this. So product one, demand is 2,000. We need 1 minute to produce one product. So in total, we're going to need 2,000 times 1. We're going to need 2,000 minutes to produce the entire demand product demand. To produce the entire demand. For product 2, we need half minute to produce one product. So what that means, that's going to be 2,200 times half minute. We're going to need 1,100 minutes. So in total, minutes to produce the total demand, it's going to be 2,000 plus 1,100, 3,100 minutes. We are short with 700 minutes the way I see it. We don't have 3,100. So we have to make a choice. Which product we should focus? Now, what's our constraint? Constraint machine one. What machine our constraint us? Oh, minutes. So if my constraint is minute, I have to calculate which product give me the highest contribution margin within the minute. So first the question is, how many products I can produce per minute? On product one, I can produce 1 unit. On product two, I can produce in 1 minute, I can produce 2 products. So now I can calculate my contribution margin per minute. $24 times 1 product that I'm producing per minute. 24 for every minute. Product one is going to generate me $24. Product two, for every minute which I'm using the machine is going to generate me a $30 contribution margin. So on which product I should focus on first? Obviously, with the one with the highest contribution margin. So that will be, this now is going to change. It's not going to be product one, my winning product. It's going to be product two, it's my winning product now. And if there's a capacity, I'm going to focus on product one. So what shall we do? Obviously, I have my capacity. My capacity is 2,400 minutes. First, I'm going to focus my entire capacity on product two. If I focus on product two, now the question is, if I focus on the product two first, product two, how many products I should produce from product two? Entire demand. So if I produce from product two 2,200 products, that's going to take me 1,100 minutes. Once I finish with product two, I'm going to check how many minutes I have available. And I can see that I have in machine left 1,300 minutes. What should I do with this 1,300 minutes? Well, we're going to focus now on product one. With 1,100 minutes, if product I can produce in 1 minute, one product, that means I can maximum produce 1,300 minutes, which is going to give me 1,300 minutes. And after I finish with this, my available minutes available is going to be 0. So I don't have more capacity on the machine one. I use all my minutes. So what's my winning strategy? My winning strategy is product two, 2,100, product one, 1,300 minutes. If I do that, I'm going to utilize my entire capacity on the machine one, and I'm going to have the highest possible contribution margin, which is going to transfer to the highest possible operating income with those two products, with this information that we have about. So let's go to the slides. Now, so information is given to us with all the selling price, variable costs, current demand, minutes per product. Capacity is restricted by machine A1. First question is, how many product units of each product can be processed through the machine one in 1 minute? We already answered that question indirectly, and the answer should be one product in product one and two products in product two. Okay, which of those products will generate then the highest contribution margin within the constraint? Is it product one? Is it product two? We established that one. That was product two, since for 1 minute process per machine, we can process two products from product two, which each product gives us $15. That's total $30 contribution margin compared to 24 from product one. And does the calculation for the contribution margin per minute. And a rationality that we should focus on product 2 first. And if there's available capacity, we should focus on product 1. If there are no other constraints, the best plan to produce demand is the product 2, and the remaining demand is going to be, capacity is going to be product 1. How are we going to do this? First, we're going to satisfy the entire demand for product 2, which is going to take us 1,100 minutes out of the 2,400. Then we're going to have 1,300 minutes available. And with those 1,300 minutes available, we can produce 1,300 of product 1. And that's our winning strategy. If we produce product 1, 1,300 units, product 2, 2,200 entire demand, then my profit and contribution margin first, and my profit will be the highest possible. In any other combination, I'm going to lose money. Or not going to be compared to this situation. The profit is going to be less than this situation. You're not going to lose money, but it's going to be less profit. So now the question is, the other question that usually get in here, why we not focus on product 2, eliminate product 1? Well, because we don't have more demand for product 2. Our demand for product 2 is only 2,200 units. And at the end of the day, yes, the product 2 gives you the highest contribution margin per unit, but you don't want to end up with the inventory. You want to, whatever you produce, you want to sell it. Let's go efficient, you to be efficient in your production and generating the cash. So let's see example here, and let's try to do this together. That's another question here that we're going to have. I'm going to copy it again, and I'm going to move to Excel spreadsheet. So we have this information. The company makes the production colonial furniture from selected hardwoods. The company supplied hardwood will be only able to supply 2,000 board feet per month. Is this going to be enough to satisfy our demand? Before we answer this question, we have to see the information which is given in the Excel spreadsheet, which will be presented to you in a second. Let me see what you're seeing. This is exactly what I want you to see. So we have our information, which is right here. So we have our 2 products, chairs and tables. We have our selling price. We have variable cost. And we have the monthly demand and how much we use. Okay, great. So now let's start working with our information that we have available. First thing first, let's push this one down. And let's see, selling price is 80 for the chairs, 400 for the table. Variable cost, 30 for the chairs, 200 for the table. Let's see where we are on the contribution margin per unit in this case. We're going to have $50 here. And we're going to have 200 under the table. So our winning product at this point is clearly the table, where the chair is and different story. That's initial thought on the situation. Now, what we have to do at this point, we have to identify, is there any constraints? How are we going to see the constraints? Well, we're going to check the monthly demand. Okay, for the monthly demand, my demand is 600 for the chairs, and 100 for the tables. Then I'm going to see how many board feet I need to produce any of those. And I need 2 board feet to produce the chairs and 10 board feet to produce 1 table. Total board feet needed. It's going to be, for the chairs, I need total of 1,200 board feet, where for the tables, I need 1,000 board feet. In total, I need total board feet which is needed are, I can clearly count here, that will be 2,200 board feet. That's how much I need to satisfy my demand. The question is, do I have that many? The supplier, from the supplier, can deliver capacity is 2,000 board feet. So the way I see it, we are short with 200 board feet. We're short. Or it should be the opposite. It should be the supplier, what supplier give us and what we need. We are short 200 board feet. All right. So we have something. What we have, we found our bottleneck. What's our bottleneck? Is the board feet. Since the board feet is our bottleneck, what do we need to do? We need to calculate the contribution margin per board feet. That's all we have to do. Do I know how many board feet I need to produce 1 table and 1 chair? Yes, I do. So since I have the board feet for those one, what they have to get contribution margin per board feet. And for the chairs will be, if the $50 I'm getting from 1 chair, which 1 chair needs 2 board feet, per board feet is going to be $25 per board feet to produce the chairs. How about the tables? Tables, same idea. It's going to come with a $20 per board feet to produce table. So now, which one is my winning product? Obviously, now shift to the chairs. So what I'm going to do in this case, I'm going to focus on the chairs first. If there's anything left, I'm going to go with the tables. So, do we have the supply capacity? Yes, we do have the supply capacity. Supply capacity is 2,000 board feet. What I'm going to do with the 2,000 board feet? First, I'm going to produce the entire demand for the chairs. Which the demand is 600 chairs. If I do 600 chairs, I'm going to use 1,200 board feet. So once I do the chairs, then I'm going to have capacity available, board feet available. And those board feet available is going to be those one. Those board feet available is going to be 2,000 minus 1,800 board feet. Now what I know is I need 10 board feet to produce 1 table. So second, I'm going to do the tables. How many tables I can do with 80 board feet? 800 board feet, obviously only 80 tables. And with 80 tables, I utilize my 800. So the board feet available, in this case, going to be 0 left. So what will be my winning strategy? First, I'm going to produce 600 chairs. And second, I'm going to produce 80 tables. So I'm going to satisfy demand on the chairs, and on the tables, I'm going to be 20 tables short. But my contribution margin will be the highest possible. So let's see this idea on the slides. The first question is, do we have enough RU to satisfy demand in forms of the board feet? Answer is no. We're short, and we're short with 200 board feet. 200 board feet we are short. So then the next question is, what is the plan for production, for using the 2000 board feet available in order to reach the highest possible profit? And that will be the entire demand for the chairs plus 80 tables. And the rationality will be here. So again, we're chasing the contribution margin which they originally generated. Then we get in, since we're identifying that the board feet is our constraint, try to get the contribution margin within the constraint. And we figure out that $25 we're getting from the chairs contribution margin for both feet. Tables is only $20. So that's why we're focusing on the entire demand for the chairs first. 600 chairs, we're using 1,200 board feet. With the remaining 800 board feet, we're going to do the 80 tables. This is the table statement, 10 board feet. And board feet to produce. And that's how we're maximizing the profits for the company. Now, the follow-up question will be, if somebody comes and say, I can provide you additional 200 board feet, what will be the maximum price which will be willing to pay for those board feet? Means the price that at least we're not going to lose money. Obviously, that will be the contribution margin per board that we're generating. So we're willing to pay only $20, which is contribution margin. That will be the maximum. Anything above, we're going to start losing. How are we going to managing constraints? The different techniques. You can add extra shift. You can add a new machine. You can add extra hours for your workers. You can hire a new worker. You can subcontract the production. You can become more efficient by reducing the defective units. There are different ways, depends on the constraint. Now, how are we going to deal with the multiple constraints? Obviously, the company is going to have the chances you to have only one constraint are very minimal. Usually, there are a lot of constraints. Even though I'm telling you the biggest constraint, the only constraint that we actually have is time. But for the purpose of managerial accounting and for the other purposes, we can find different constraints for different situations. How are we going to mitigate those ones? By using the linear programming. On the linear programming, we're not going to spend time. So this is just something for you to know that we can manage the multiple constraints with the linear program. And that's where we're going to end up with this chapter 12. Now, costs and how we're going to price our products. That will be subject which will be discussed by the teacher with whom you're going to take the intermediate managerial accounting. In the intermediate managerial accounting, you're going to discuss the different strategy to price the products and the services. Very interesting topic. I strongly recommend you to pay attention when the teacher teaches those lectures, because at the end of the day, now we saw the different type of costs, how we make decisions, but the main decision is what should be the hour price for our product, which is going to generate the revenue. So that's with the chapter 12. We're going to only focus on the transfer pricing, quality of cost, service department cost allocation. Those one I'm going to leave it for the teachers in the intermediate managerial time. With you, only transfer pricing. Why transfer pricing is important? Because the transfer pricing gives you idea how to motivate the managers to work in the best interest of the company. Transfer pricing is used only and only within the organization. When one segment of the company producing something which is used or purchased from another segment of the company from outsiders. For example, let's say I'm Samsung, one of my departments making only screen for cell phones, which screens for cell phone, that department selling outside. The other department make the entire cell phones, but the screen that they using, they purchase it from outside. So now the question is, can the department that internally making the screens for the cell phone can sell it to the department internally, which currently purchases it from outside? Now, the tricky part is that the company, the department who's producing those screens for the cell phone, they're selling it for $100 outside. And the company buying the screens for the cell phones from outside for $80. You see, now the price that we're charging our clients for the screen is higher than the screen that we purchase from outside, which is matching the same quality that we're using in our cell phones. That's the tricky part here. So now, how can we make those managers to work in the best company, best interest of the company, and at the same time the company to generate profit overall? There are three common approaches for the setting up the transfer price. One is the negotiated transfer pricing. So now, in order to establish the negotiation, we have to have a room for negotiation. That means we have to have the minimum price and the maximum price. So the minimum price will be the transfer, the cost of the selling division that's selling outside the screens. Well, depends what will be their variable cost. So they can transfer it to the other division internally at variable cost. The transfer, what will be the upper limit for the negotiation will be the market price at which the buying division buying from outside. So again, in order to have negotiation transfer pricing, we have to have the limitation for the upper limit and lower limit. Lower limit always going to be the cost for the selling division. Upper limit is going to be determined by the buying division, or what will be the purchase price for the buying division for the outside. And then both managers can negotiate the price. So let's see how this is going to work. Let's pretend that we have this company which have beverages and pizza place. The beverages, they're producing a ginger beer, and their capacity is 10,000 barrels. Variable cost per barrel of ginger beer is $8. Fixed cost, 70,000. Selling price, they're selling the ginger beer for $20. Pizza place, which is under the same umbrella, same company, purchasing the ginger beer outside for $18. So now, as you can see, if the selling division sells on the selling price, the pizza place never going to buy from inside, because it just doesn't make sense. Why would they pay $20 for inside when they can purchase from outside for $18? The monthly consumption for the ginger beer for the pizza place is 2,000 barrels. Now the question is, can we make a transfer between one division and another? And what will be the transfer? The transfer price, the lowest acceptable transfer price, will be calculated as a variable cost for the making division or the selling division, which is $8, plus any contribution margin that they might lost from stopping the regular sales. So it will be the variable cost plus the total contribution margin loss of sales divided by the total of all the units which are transferred. The transfer pricing for the buying division, it's always going to be the cost that they buy from outside, or $18. So let's see how exactly the formula is going to work. First scenario. This company has sufficient idle capacity. As we remember, the capacity, they can produce 10,000 barrels. Currently, they're producing only 7,000 barrels, so they have 3,000 capacity. So the 3,000 with the 3,000 capacity, they can satisfy the demand of the pizza place. Absolutely. They're not going to sacrifice any sales. It's not going to affect our normal sales. So for that reason, there will be no contribution margin lost. So if the contribution margin is not lost, then the transfer pricing can happen on the variable cost only. So that will be the minimum on the lowest possible transfer price. The highest possible transfer price will be the cost for the purchasing division, which they currently pay for the ginger beer. They currently pay $18. So in this case, as you can see, the minimum price that the transfer can happen is $8. Maximum price that the other division is going to be willing to pay is $18. Anywhere between 8 and 18, the transfer can happen. So now we're going to let the two managers to start negotiating and come up with something reasonable, which for both divisions. But that negotiation will be within the range of $8 to $18. Second scenario will be when the selling division, which is the ginger beer, don't have capacity. If they don't have the capacity, that means the cost still going to be $8. That's a variable cost. But also, they're going to lose the contribution margin on the entire transfer of the units. So since they don't have the capacity, means that they have to stop the regular sales to the customers from which they're charging $20 and transfer it internally to the other department. In that case, the minimum price that they'll be willing to sell the ginger beer will be $20, or the regular price that they usually sell to the customers. Because again, I don't have the capacity. I'm stopping my regular sales at $20. So if you want those 2,000 barrels, you have to pay me the $20. Now, but the other division currently purchasing from outside for $18 only. And they're going to say, that doesn't make sense. I'm not purchasing from outside for $18. Why should I pay $20? So the minimum price, as you can see, will be $20, but the maximum price that the purchasing division is going to be, pizza place is going to be willing to buy will be $18. In that case, there's no room for negotiation. In this case, transfer is never going to happen. And the third scenario is when the ginger beer department has partial capacity. Means they can produce 1,000 within the capacity, and for the next 1,000, they have to stop the regular sales. So the first 1,000, okay, I can transfer it at the minimum price will be $8. Now for the second 1,000, you have to pay me the variable cost plus the contribution margin that I'm losing since I'm stopping my regular sales. So in this case, as you can see, the minimum price will be not going to be the variable cost, it's going to be above, but it's $14. $14 will be below the highest possible transfer pricing for the buying division or pizza place, which is $18. In this case, again, can be negotiations. However, for the best interest of the company is the ginger beer to transfer only 1,000 barrels. If they want to transfer, don't stop the regular sales to the customers, because once you stop the regular sales to the customers, next month the customer can come and say, I don't want to purchase from you anymore because, I don't know, you may have to do the transfer price. So do your transfer pricing. So in that case, don't do that. I mean, satisfy, fill the capacity up to the capacity. If you have to transfer internally, but up to the capacity. Don't stop regular sales to make internal transfer price. In that case, because in that case, if you stop the regular sales, you're losing the $20. The other division, they can buy it from outside for $80. They're never going to pay you $20 anyway. So for that reason, keep selling at 20. The other division keep buying for 18, and everything is in the best interest of the company. Now, how are we going to do the negotiated transfer price? If the transfer pricing within the company will result in higher overall profits, there are always a range of transfer pricing within which both selling and buying division will have higher profits if they agree to transfer. Now, if the manager are competing with each other, they won't cooperate for setting up the best transfer price. When we have those disputes, what that means the company have to step up, and somebody has to come and say, hey, this is the transfer pricing end of the story. If you don't like it, that's the way it is. Now, why we should transfer at the selling division cost? What's going to happen if we doing the transfer pricing at the minimum cost or the variable cost or full absorption cost for the selling division? If that happens, there will be negative tension increasing, because using full cost for the transfer pricing can lead to sub-optimization. Also, the selling division department never going to see profit on the internal transfer. Why? Because they're selling at the break-even. Cost-based transfer pricing does not provide also incentive for control cost. So if you're evaluating the division manager based on the profit when there's internal transfer pricing, you have to change the evaluation. The other option is not on cost, to be on the market price or the cost for the buying division, which is again from the market. Market price approach works best for the production, which is sold internally when there's some idle capacity. The market price approach does not work well with the selling division. So division autonomy, obviously we're going to give, to keep the spirit of decentralized system in our organization, we're going to give some autonomy on our managers to do the negotiation. However, keep in mind that you always can step up and override whatever they negotiate. What's the benefits of the transfer pricing in general? On the domestic level, that will be great division autonomy, great motivation for the managers if you use it correctly, better performance evaluation if again use it correctly. International will be, you can save on taxes, duties and tariffs. Less foreign exchange risk since you're doing everything internally. Better competitive position, again, since you're doing it internally. And better governmental relationship if you're having between the different countries. And that will be all for the transfer pricing. So the transfer pricing is very interesting tool. that can be used within the company. Again, remember, it's within the company. The minimum transfer price is the variable cost of the selling division. The maximum transfer price is the purchasing cost for the buying division from outside. And somewhere in the middle, there might be room for negotiations. And that's with the transfer pricing, and that's with this chapter, that's with this course.